Ladies and gentlemen, welcome. My name is Alex Dworkin, and I'm a managing partner at 4D Capital. We specialize in a very unique mathematical approach to the stock market, where we analyze the market and individual stocks in multidimensional space. And when we do, essentially perfect order emerges. On top of that, we've developed a number of very important mathematical tools and timing tools. And when we combine both of those together, we can essentially predict with great accuracy exactly what the overall stock market or individual stocks will do going forward in both price, very important, time. I personally believe our work is nearly identical to what Jim Simmons was able to accomplish at Renaissance Technologies, if you're familiar with Jim. So our primary goal is to identify equities that will appreciate quite significantly 2x, 5x, 10x, and do so within a relatively short period of time. And of course, whose goal it is not, right? But we have a very special weapon when it comes to that, and that special weapon is our software that has been developed on top of our mathematical work. And that particular software allows us to, for example, scan the entire S&P 500, identify stocks that are coming up with very important long-term bottoms, because it's a lot more difficult to make money on the short side, and your gains are limited to a certain extent unless you're using options. But what we do is we identify those bottoms, and from those bottoms, our software is able to project exactly what that stock is going to do going forward, once again, in both time and price, and we simply pick out only the best opportunities. So as opposed to doing an individual stock analysis today, what I want to do is just look very quickly at the fundamental composition of the overall market today, and use Warren Buffett's massive pile of cash, as well as the Buffett indicator, as well as the Shiller PE ratio, to essentially suggest to you or show you that we are sitting at the highest level of valuation that has ever been recorded in the overall stock market. Okay. So this is a prominent opinion today. This is from Yahoo Finance just a few minutes ago. And as you can see from the headline, it tells you everything you need to know. This is what most people anticipate in terms of the overall stock market. That's what most money managers kind of anticipate. Everybody knows that the stock market is speculative. Everybody knows that the stock market is very expensive. But at the same time, the psychological background of it all is this. Okay, so as you can see, AI investment is rising, or people are putting more and more money into it, and according to some market strategists, this particular bubble, even though everybody knows it's in a bubble, that this particular bubble has ways to go. We'll talk about the timing of this bubble and exactly what the overall stock market is going to do going forward at the end of this particular exercise. But nevertheless, that's the prominent view on the street. Everybody knows it's a bubble, but nobody wants to get out of it, because everybody continues to think that it's going to keep going higher and higher and higher, and people's going to make easy money. The same psychology that we saw in 2000, same psychology we saw at 2007 top. So it is once again prominent today. But this article from Zero Hedge from a couple of days ago, basically Berkshire cash pile hits record 382 billion amid continued stock sales and T-bill purchases soar. So basically, Warren Buffett's sitting on a massive historic cash pile, and the very easy reason for that is because there's nothing to invest in. As you know, Warren Buffett is a value investor. He seeks out value opportunities, and at the present moment in this particular market, the most expensive market in the history of the mankind, as I would argue, and I'll show you a chart here in a second, there's absolutely nothing to invest in, okay? Particularly if you're working with so much money. Sure, there are certain special opportunities here and there. There's smaller stocks, perhaps, that have certain value associated with them. But overall, Warren Buffett looks and sees that there's nowhere to allocate capital. And at the present moment, the most risk-averse, remember, his rule number one is not to lose money, and rule number two is the same, or follow rule number one. I think that's something like that. So rule number one and two are basically the same. But basically, they're investing in T-bills, 4 or 5%, great money. No risk associated with any of that, because the overall stock market is getting ready to take a major haircut, and everybody knows that. And everybody's playing this game of musical chairs, but Warren Buffett is not. As he always pulls back. 2000 top, 2007 top, prior tops before that as well. He's been in this business for a very long time, and that's what he always does. When the market gets out of whack in terms of valuation concerns, he goes into cash, and it's simple as that. So let's see. So this is the chart that I've been talking about for some time. Okay, so Shiller PE ratio, and just to set the background of it, basically, as you can see, we are currently S&P adjusted S&P PE ratio of 40.88, the highest it has been in valuation. Now, many people will argue with me and say, well, 2000 top was a little bit higher, and therefore, we still have room to run. But as I've argued before, this particular top in 2000, what was it actually? Let's see. It was 44.19, right? So it's like trying to get blood out of a stone in today's valuations. But as I've argued before, this particular top was a little bit distorted because if you would recall 2000 top, there were a lot of companies, well, I'm not sure a lot could qualify, but quite a few companies that had no earnings. And because of that, this particular PE ratio was distorted, right? It was higher than it needed to be. Now, I did a study approximately 10 years ago. It suggested that at that time, the PE ratio should have been approximately 35, if you take all of that into consideration and make some adjustments. But regardless, splitting hairs here. Today's top is a lot higher than 1929 top, right here. It is higher than 66 top. It is higher than 2000 top. 2007 top was all the way down here, and all prior types. So what this chart basically is telling you, AI or no AI, we are currently sitting in the most expensive market in history of the stock market. Since it's opened in 1790, I believe, New York Stock Exchange opened. I think there was a different name for it, but nevertheless, kind of going back too far in history. Anyway, yeah, it has never been more expensive than it is today as we speak, right? So, and this particular measure is just yet another indicator that it is the most expensive market. The Buffett indicator, right? You take the stock market valuation and divide it by annual GDP, which is, I would argue, inflated through various means. But nevertheless, once again, you see it's the most expensive market that it has been in history. And just as previous chart suggested, just to go back to the mean, you would have to lose mean PE ratio, let's say 15, and this particular historical trend line you see right here. So just to go back to the mean, not oversold conditions, just to the mean, it would have to lose from today's valuation levels approximately 60% of its value. Okay, so all of those things are suggesting that the market is extremely expensive, very risky. Obviously, most people want to continue to play this market because they think that, for example, the PE will go from 40.88 to that magical top that we saw in 2000, unofficial top, I would say, of 44 something. So everybody believes that they can squeeze another 10%, 20% out of it. Everybody knows that they're playing a musical game of chairs, but everyone is still playing. But I would like to caution you here, as Warren Buffett is very clearly doing, that he's going all into cash. And as the Buffett indicator clearly suggests, we are once again, just yet another indicator that we're sitting at the most expensive market in history. Now, according to our timing and price calculations, the stock market is very near a top, assuming the top is not yet in. And as soon as that top is put in place, we're going to have quite a significant sell-off. Now, I'm not giving this information out in this form for various reasons, but if you would like to see the actual time and price targets for this overall stock market top, I highly encourage you to request a free trial. Link in the description of this video, and you're going to be able to see both the time and price parameter for this anticipated top that is coming up very, very soon. And once that top is put in place, the market will indeed have quite a significant sell-off. Not a crash, but quite a significant sell-off. And then the recovery will start. But Warren Buffett, for example, will deploy that cash right to the bottom of the market, as he always does, when we reach the historical trend line or historical mean that yields those valuations that to a certain extent make sense. So that's it for today. Thank you very much for your time. And we'll be back with another stock update tomorrow. We have actually quite a few stocks that we'd like to discuss throughout the week. So please join us, subscribe, and I believe you will find the information quite helpful. Thank you very much for your time. Bye-bye.